right, I think we're going to go ahead and get started. This is our Money Skills for Life class. And this is actually our fourth of a 12-part webinar series where we're going to be covering and discussing a variety of personal finance topics. My name is Michelle, and I'm a financial advisor. And today we're going to be covering the differences between credit reports and credit scores. And I think that these often get interchanged pretty easily, but there is a huge difference between those. And this is kind of a pretty good short guide to kind of explain some of those differences. Now, the easiest way to kind of distinguish between the two is this right here, the score. If it has a number associated with it, it is going to be a credit score and not a report. But understanding what the differences between the scores and the reports are is pretty important too. Now, a report looks at, if you think of it like a class, a report is going to look at all of the grades, your homework, your quizzes, your participation, and your final exam. So the report looks at all of those individual things. And each one of those may have a different weighting. For instance, your homework may be worth 20% of the grade, your quizzes were 25%, participation 15%, and let's say your final grade is worth 40%. That's what the report's doing. It's kind of taking all of this individual information, assigning a weight of the grade that it's going to provide to you, and then ultimately provide your score to you. And so your credit score is that final grade. Now we can see here that the big differences were that the score does actually have number values associated with it, whereas a report is not going to do that because it is going to include your full credit and payment history. So your score is just really a summary of all of the stuff that goes on in the report. Both of them can impact if you're going to rent or any type of lending that you're trying to get, whether it be a credit card or a car loan or a mortgage. And by looking at either the score or the report and digging into the actual report, either one of those can tell you if you have, good or bad credit. Now, there are three primary reporting agencies. There's Equifax, Transunion, and Experian. Now, each of these are responsible to house all of the information that's being reported to them from the different lenders. And each lender they usually do, reports to all three of them. However, if you're getting a loan or applying for a loan, that individual financial institution typically only pulls from one of them. They're not going to necessarily pull and run your report or request your report from all three, but they typically do report to all of them. Now, what happens is all of these different agencies collect all of this information and they apply an algorithm to the information of all the details in that report. And then it comes up with a score, and we're going to look at that in a little more detail in a moment. But FICO is a very common one. That's actually the most common one that we see. Now, this is a sample of a TransUnion report, and this is some of the information you'll see in the report. They're going to collect data such as your social security number, your date of birth, how long you've had credit, and also what types of addresses you've had. And you can see here, this person's moved quite a bit. Any phone numbers that you've had, your employment data, it's going to collect quite a bit of information from you. And what they can gauge from this information is maybe do you move around a lot? Is it because of your job, or do you just move to a lot of different places because maybe there's an issue with credit? Maybe you're being evicted from an apartment for non-payment. And so some of this would show them that if you move around a lot, it's not really showing stability. And so that can dink your credit a bit. It can have definitely an impact on your score. Now, most credit reported information comes from a variety of financial institutions and lenders. So all of the different banks and credit unions and lenders out there are what we call data furnishers. And they report all of this information to the three bureaus. And then when you form a relationship with a credit card issuer or a loan provider, that information may be reported to all three agencies, whereas they're only pulling again from that one particular. So for instance, on this credit report, they've only pulled from Transunion, but the bank may have reported the information that you've supplied on that credit application, whether it's online or in person. They have access to push it towards all three credit agencies. Now, some of the information that gets reported, not just your name, address, and employment history, but also how you are making payments on individual loans. And this one kind of breaks it down a little bit in a little bit more detail. It talks about the loan type it is. And in this particular case, it's a credit card. And a credit card would be considered a revolving account. It shows the responsibility of the account owner. Are you an individual account owner, or is it a joint account? Maybe you're a co-signer on an account, or maybe this account, you've had a co-signer supply a signature guarantee as well. The date that you were employed, the last payment amount, how much you should be making a payment for. In this instance, it's probably looking at this $27 a month being a minimum payment amount. For a car loan, that may be obviously a lot more. And it would probably list on the terms how many months the car loan was for. So if you're doing, say, a 5-year loan, it's going to show 60 months for whatever the payment amount is. And we can see here that it's reporting, and the bank is reporting to the credit reporting agency. In this case, it was TransUnion. Each month, it's going to report how much was owed, what the balance was, the scheduled payment, and if you made the payment okay. Was it late? Was it less than it was supposed to be? And in this case, these were all okay, so they get the green light on them. It also looks at a high balance and a credit limit. And the credit limit is important when determining how credit worthy you are, because since we're looking at a high balance and a current balance, let's say that you have a credit limit of $1,000 or let's say $10,000 and you have $1,000 balance. Well, that's going to show us that you've used 10% of your limit. Whereas if we have $1,000 balance and we're not sure of what limit that is, we have no way of using or calculating the credit utilization. And we can also tell if there's a $1,000 balance and a $1,000 limit, well, you've kind of maxed that out. And if you only have an $800 limit, well, you've gone over limit. So that's not very credit worthy. And so what we do is these credit agencies throw all of this information into a bucket, and then it applies this algorithm, and it comes up with ultimately this score. And the most popular one, as I mentioned, was FICO. Now, FICO, it actually was called the Fair Isaac and Company, and it's a data analytics company focused on credit scoring services. Now, it was founded by Bill Fair and Earl Isaac back in 1956, and it's used as a measure of consumer credit risk, and it is one of the most common among the lenders. And what I mean by credit risk is that if I lend you, as a lender, if I'm lending you money, what risk is there that I'm not going to get that back? And if it's a pretty high risk that I'm not going to get it back, odds are I'm not going to loan you the money. But if I can see on your report that you've made the payments and you're not going over limit, then I would be more apt to do that. Now, back years ago, whenever someone would apply for a loan at a bank, and this is going to kind of age me a bit, we used to have to run all of these different calculations. And we would look at the debt to income ratio. We would look at credit limit to balance ratios. There were income to balance ratios, income to limit ratios. We would calculate all of this. We would look to see if there were any late payments. We would look to see if how long they were at their job, basically all of this stuff that we just looked at and a lot more. And then it would take a tedious amount of time sorting through all of this information. And then we would come up with not a score, but basically just a general idea if there were any risks associated with. And also, what is this new payment that they're going to be, that they're applying for? What is this going to do to their credit utilization as well? And so it would take a long time to calculate some of this stuff out. And so that's why this FICO score is so important now. It's because it made it so much easier. Instead of a human calculating all of this stuff, now it's being done by a computer. It can be done much quicker, and we're eliminating that human error possibility. So FICO was definitely a game changer in the lending industry. Problem is, not everyone understands how FICO works. In fact, they think that there's one score, one version, and that's it. And in fact, there are 28 unique scores that are optimized for various credit card, mortgage, and auto lending decisions. And we can see that right here when we look at Experian, Equifax, and Transunion. Now, the most widely used version is this FICO Score 8. And you can see that each of the three agencies typically use this one, but there are industry specific ranges. Now, on that first slide where we looked at the score being usually ranging from 300 to 850, on these industry specific ones, some of those ranges can range from 250 to 900. So it's a little bit different. And that's why they kind of list this score as a separate. It's not just score, but this is auto score, this is bank card score, and there's different versions of it as well. Now, auto lending usually uses either the 8, which is similar to this. It's just used for auto instead. And it can, in certain cases, be the 250 to 900 range. But we can see most of them use the 8 version. However, they can use different versions as well. Typically, Equifax is going to use, if they're not using the 8, they'll use the 2. Experian uses 2, Equifax is 5, and TransUnion is 4. So I know that if I go to a lender and I know that they're using a score 5, I know that they're pulling my information from Equifax. Credit cards have kind of that same distinguishing mark, whereas 8 is kind of common across the board. They also have 2, 5, and 4. And on Experian, they also use a score 3, which is similar to this 8. But if we're already on version 8, you can see how old this one is. But if it's working for a particular company, then there's no need to change on that. Now, mortgage lending is a little bit different. While they can use FICO Score 8, they typically drill down in a little bit further on certain things. And so we can see on score 2, 5, and 4, which if you notice, these are all kind of the same 2, 5, and 4 across the board. So you know that if it's a 4, it's definitely TransUnion, 5 is Equifax, 2 is Experian. So it does have a little bit more stringent criteria in the lending. And so they do specify one for that. They can use the FICO 8, the score 8. And now there's even some newer released versions that are the 9. And we can see that maybe they're kind of getting rid of all these 2, 4, 5, 3s and making it just the auto score, bank score, and regular score 9. Now, not every bank has to use the same one. And we can see here that each of them, TransUnion, Equifax, and Experian, are all looking at moving stuff to this new score, but it's certainly up to the lender as to which one that they want to use. Now we can see here that even though we're using the same score, this is score 8 on FICO, but Equifax, TransUnion, and Experian, they're all kind of reporting different numbers here. And they're able to do that because of the data that they've received. Again, not every reporting agency or every financial institution is going to throw that specific information. They should, and they can, but not all of them do. And it depends on what weighting that they put. They have maybe just a little bit different weighting. As I mentioned, not every single algorithm is the same. So there's multiple ones, and depending on which agency depicts which one can be used. Now, on the FICO scores, usually we said the 28 versions of it, but this is typically what most lenders are going to see, the range from 300 to 850. The Vantage is another credit scoring agency, and this is one typically used for, you see those free versions like on credit cards or attached to a bank account, and where it pulls up and says your Vantage score, your credit score is this. FICO scores usually aren't pulled as common. The ones that you see that are updated like monthly are usually this Vantage score. Now, Vantage has 4 versions. And so it's 1, 2, 3, 4 on theirs. And it also incorporates data such as like rent, utility payments, cell phone bills, public records. A lot of that stuff isn't reported in FICO. So for instance, a department store card, let's say that you have like a Kohl's card that's not necessarily a Visa or MasterCard, but you can use it only at that store. Oftentimes those don't get reported to the 3 credit reporting agencies. And so of course, they're not going to be incorporated into the FICO score. Excuse me. Some of those are incorporated into the Vantage score. Now, rent usually is not incorporated into the FICO score either because it's not a loan. You're signing a contract saying that you agree to make this particular payment, but there's not really a loan on it. You're not, you don't have the ability to go like charge popcorn to your apartment. So it's not necessarily a loan, but you do need to make those payments. So that's not going to be incorporated into the FICO score, whereas it does often get incorporated into the Vantage score. Now, another difference is the Vantage score usually starts reporting or using those items and reporting them into the score after 1 month of a payment, whereas the FICO system requires 6 full monthly payments before it even looks at putting it onto your score and giving you credit for it. Now, Vantage scores, like I mentioned, are the ones that are most commonly seen on like credit cards and checking accounts and things like that, or free on websites where you can use, for instance, Credit Karma and all these different free systems. A lot of those will use the Vantage score. Some of them do report on the FICO, but a lot of those report on the Vantage. So it's important to see which one they're reporting on, particularly if you're applying for a loan, because we can see here that not only is the weighting or the percentage is different on this, this is kind of more evenly dispersed, whereas you can see here that the poor and the excellent credit takes up a much bigger swath than it does on this or on the FICO score. So this is a little more evenly dispersed. A lot more people are getting excellent credit here than they will on the exceptional side of FICO. In fact, to get excellent credit on FICO, it needs to be an 800 score, where over here you're in the dark green, which is excellent, thumbs up, at 750. So if I were to go apply for, let's say, a mortgage loan and I have a 760 score, well, guess what? I don't have an excellent score consider on the FICO system. So I might get a much higher rate than I was anticipating, only because I mean, it's still good. I'm still in the green. I have a very good score, but usually for an exceptional rate, you're wanting to have an exceptional score. And with FICO, that is 800. Now, I mentioned different weightings. And what I mean by that is, for instance, a payment history. All the payments that you've made throughout the entire time you've been making payments count for 35% of your score. Amounts owed, 30%. Length of credit, 15%. The types of credit and the new credit each account for 10% apiece. Now, we know on credit history, we can't change history. So it's very hard for us to make any changes on this except going forward. We can continue to make payments on time and the amount that's due on time. So we can work on that credit history. Length of credit history is the amount of time that you have had credit. So if I've had a card for 10 years, that's my length of credit history. It doesn't mean that I've had to use it that whole time. It doesn't mean that I've had to make payments on it that whole time, but it's how long I've had it open. And I can't change that either, right? I can't like extend history. So I know that about 50% here, I can't change. However, I can change how often I apply for a card or for a loan, the type I'm applying for. Am I applying for a car loan or am I applying for a credit card? I can affect the type of credit. And I can also, and this is a big portion of our percentage of score, is the amounts owed. Now, the amounts owed look at that credit utilization that I've been speaking about. And it also looks at the balance to limit. So if I have a $500 balance on a card and I have a $10,000 limit, well, that's a pretty low utilization. But what if I have a $500 balance on a $500 limit? Well, I'm maxed out. So that's what we look at when we say credit utilization and balance to limit ratios. There's also debt to income ratios and limit to income ratios. So we can definitely affect this here. And I know this sounds really confusing. So let's take a look at what that kind of means. So let's say that we have two separate credit cards, one with the credit card one has a $10,000 limit and credit card two has a $10,000 limit as well. So our total limit, the total amount that we can access would be $20,000. Let's then say that we have on our two cards, we have a $25 or $2,500 balance on each one. Well, our individual card ratio would be 2,500 divided by this 10,000, and that's going to give us 25%, right? 2,500 is 1/4 of the 10,000, so it's 25%. Same thing on card two, and our total of these two are going to be $5,000. So we have $5,000 total debt on two different cards. And if we divide that into this 20,000 too, we're going to get 25% total credit utilization. So 25% utilization on each individual card and 25% total. What if we have exact same limit, exact same total, but we shift those balances a bit? Let's say we put it all on card one. Well, now we've increased that individual card utilization to 50%. And even though we have 0 here and our total utilization is still the same, this is going to show us as being a kind of an uh-oh moment because we want to stay under 30%. So if I had an expense that I knew was going to put me over 30% here, it might have been a better idea for me to divide those onto those two cards to keep my individual utilization under 30%. Even though my total utilization was still under 30, we want to do that on an individual basis and a cumulative basis as well. Now, what can cause a bad credit score? Well, we saw making late payments, right? That's 35% of our score. Maxing out credit cards, that's 30%. That was our credit utilization. Applying for too many cards, that was 10%. So we definitely need to we have the ability to change that by not applying for so many. And closing zero balance lines of credit. Now, not many people realize this one. And if we look back at this slide here, if we had eliminated this card too, so let's say that we have a 0 balance and we say, you know what, we're not going to use it. We don't want to have it around. We don't want it to be tempting us to use. We're just going to cancel it. What have I done? If I cancel this card, I'm lowering my total limit that I have access to, and that's going to then increase my credit utilization, right? Because now I have a $5,000 balance and my total credit limit would only be $10,000. So I'm at a 50% per card and total utilization. So it's actually better for me to keep that card with the zero balance than to cancel it out. So a lot of people don't understand that. You have to look at not only the per card instance or credit utilization, but also your total as well. And by canceling those zero balances, you can increase your utilization on the totals. And obviously, refusing to use credit at all can create a bad score. And not that you're using it incorrectly, but if you're just not using it at all, then there's nothing for the financial institutions to report to those agencies. And so there's nothing that they can really grade you on. Now, how long do things stick around with you or on your report? Negative credit accounts may remain on your credit report for up to 7 years from the date of default. And we call this terminal delinquency on an account. Another way to look at it is that a negative account may stay on your credit, or negative accounts may stay on your credit for up to 7 years and 6 months, which is an additional 180 days from the first missed payment that leads to the default. And so that can stick around with you for a good long period of time. So it's important to make your payments, not have that negative score, because it's going to, even if it was a hiccup or a misjudgment, it's going to stay around for a long time on your report. Positive accounts, on the other hand, are going to stay on your report for as long as that account remains open and active. And so as long as I have an open, active account, which means that if I'm not using a card, let's just say that I want to keep that zero balance card around and I don't want to cancel it to lower my credit utilization, or raise my credit utilization, lower my credit limits, then maybe what I should do is go make sure that it's active. So go make a charge on it once every 6 months, pay it off, and that keeps it active. That way that the lender's like, look, this person's not even using this. We don't even know if they realize that they still have it. We're going to go ahead and cancel it on them. That's going to lower your total limits that you'll have access to, which is then going to raise your utilization total as well. So make sure that there is an active, that if you have an account that remains open, know that it needs to remain active as well. Doesn't have to be every month, but at least once every 6 months to a year. And closed accounts in positive standing usually remain for 10 years from the date the account was closed. So even though there's not really a law on this, it is kind of a credit bureau policy that things are going to stick around for 10 years. So if I were paying good and I had active credit on the card and then I decided to close it, it's still going to show on my report for about 10 years, even though even though I don't use anything on it anymore. So delinquency 7 years, inquiries are going to last for 2 years. So if I decide that I'm going to go apply for a credit card, whether I'm approved or not, that inquiry is going to tag my report for 2 years. A little bit different if I'm going, let's say that I'm going car shopping. And a lot of times the car dealer will throw your credit application out to various lenders. And so they may send it out to 5 or 10 different lenders at once, and to see who is going to offer you the best deal. And because sometimes it's not just about your credit, it's about how much money that lender has available to lend to you and what those rates are that they can offer you. So by sending it out to multiple places, usually you can shop around for a good deal. Now, in theory, when I just said these inquiries will last on your credit for 2 years, if they threw it out to say, a dealer throws it out to say 5 different people, are all of those 5 going to show on my credit for 2 years? No, that's what we consider a shopping inquiry. So you'll only be tagged with one of those that are going to have an impact on your credit. Bankruptcies do stick around. This is kind of debatable in lending. Usually, it used to be 7 years, and now certain bankruptcies can last for up to 10 years on your report. So 10 years is usually what we look at, just a nice even round number. But yeah, 7 years for delinquency, 10 years for bankruptcy, 2 years for inquiries, can be 10 years for closed accounts in positive standing, negative accounts 7, and positive credit accounts on, if you closed them out on your own and they, if you haven't closed them out and they remain active, those are going to stay on forever. So I can have a card that's 20 years old and it's still going to report as good standing on my credit. Now, I mentioned the differences between FICO Score 8 and the newer one, FICO Score 9 now. And the big differences, there's not a lot of them, but some of the bigger differences, for instance, on the 8 was these isolated late payments are a little bit more forgiving. And we see this as being kind of an important thing, looking at what all's happened last year during COVID, where maybe hours were cut back, income was reduced, and it was a little bit more difficult to make payments. And so a lot of credit cards and any lenders, in fact, were a little more forgiving and not, just reporting that on the report. I mean, it's going to get reported, don't get me wrong, but it's not being looked at a little bit more stringent because they look at that being an isolated thing. It was due to a certain situation. And as long as it's within a shorter period of time and not a recurring theme, then they're going to be more forgiving of that. And something called trade line renting, which is kind of an interesting thing. It's not very easily understood. But let's say that I have a really good credit score and yours is not. If I add you to my account as an authorized user, you can kind of piggyback on my good credit. So by being on my account as an authorized user, then it will then increase your credit score. And so this was a feature that people figured out. And so as a good lender, as a good consumer with a high score, I could then, say, hey, I'm gonna rent you my line of credit, and maybe I can get some compensation off of this. I'll charge you $50 and you give me this, and I'll put you on my credit and you can stay on there for a month or two until yours goes up, and then I'm going to cancel you off. That's not going to last. I mean, that's not going to work anymore. Now, if my son, for instance, whenever he turned 18, I added him as an authorized user and I kept him on. So that definitely helped him on his credit score. It gave him a really good start in life with credit, and but he got to piggyback on mine. But if I'm just putting someone on and taking them off and putting them on and taking them, different people, that's not going to work anymore. They kind of got wind of that, and that's not going to really help out as much anymore. Now, something that changed with FICO Score 9, if you remember when I talked about Vantage scores, we said rental history could be reported on that, where it wasn't so much on the regular FICO. Well, they're starting to look at that a little bit more. Now, usually with rental history, if I'm renting an apartment, they may be more apt because there's more people involved in it. They may be more apt to throw those that lending out there for the 3 credit reporting agencies. But if I'm renting a house from a landlord that he's only got one house, he's probably not going to take the time to really report all of my payments to the particular entities, because that's one person. And so with rental history, when it is reported, and so this would be more so along the lines of if you're renting from a property management company or an apartment, they may report that history, whereas renting an individual house from an individual person probably is not going to be reported. But if it is, the rental history is looked at in the Score 9 now. And also, one big thing that changed was medical collections are treated a little bit differently. Now, 1 in 5 individuals owe unpaid medical bills, and it may take quite a long time to pay off some of these things. Oftentimes there's, some minimum payment that's due, but it takes, it may take years and years to pay those off. And usually what happens is if you can't pay them in full, they could set up a payment plan, but it could be turned over to collections if you can't pay on some of those. Some of them are like, we want this money, and we don't really do payment plans. It's due upon, services rendered. And so it may get turned over to a medical collection agency. And those are going to be looked at a little bit differently now, because there were so many that, let's say that I'm paying all of my other bills on time, my mortgage, my car, my credit cards, everything. And I have good credit utilization, and I'm not, applying for too many cards. So all things being the same, but then I just have this one medical thing that's just dragging my score down. We're not going to put so much focus on that anymore. So that was a really positive thing that Score 9 is taking into account. May take some time before a lot of the institutions transition over to this, because we saw in some that they're still using Score 3, but eventually they'll usually go to some of the more current ones, and hopefully they'll push those lenders to 9 as well, and kind of get a more cohesive and consistent reporting. Now, next time, our class is going to be on April 9th, and we're going to be talking about owning property. So how much does it really cost to own something, like own a car, own a home, own other property, own a dog? And I can tell you on my little babies that are around, I have 2. One is a 5.5-pound little squirrel warrior. He takes a lot of time. He wants special treats. He wants special toys, and he can cost a lot of money. There's food, there's vets, there's medication, there's all kinds of things. Owning a car, you may be able to afford to buy a car, but what about the insurance? What about the maintenance? What about the tires? What about the registration, the fuel, all those types of things? So we're going to dig into that a little bit more next time. But if I don't have any questions, I know I went a little bit longer than what we anticipated.